Good afternoon, everybody. Welcome back to Market Insights with Linux, and welcome to this new video in which we're going to be talking about the stock market in general. What's going on with the stock markets right now, what to expect in terms of a continuation. We obviously opened about an hour ago. Since then, the opening has been good, but before that, and I'll be able to show you that with the futures, right here, we had a lot of bearish pressure, right? So you might say, okay, the thumbnail is a little bit of an exaggeration, and I would agree. I think it is an exaggeration, but ultimately this is one of the biggest red candles we've had in a while, right? Like the last one was obviously in October when we had that escalation between China and the United States. But before that, a red candle like that barely happened. Before that, the other time is the 31st of July. So it doesn't happen often. I'll tell you what is going on, and I'll tell you what to expect from here. Now, ultimately, what to expect from here is always an uncertainty, right? But I'll at least tell you my thoughts on it and my personal actions regarding that. My apologies for no video yesterday, by the way. I mean, some of you might know that I'm a crypto trader first. I do trade stocks as well. I actually opened a stock trade or swing trade, I guess you should call it. More specifically on Meta, which I also spoke about in the video, and in the Telegram channel that we have, which is down below. It's completely free, all right? It's not a paid channel where I send signals or anything. It's just basically what I do. And if you're interested in that, consider joining that. Links will be down in the description. Okay, but let's talk about let's talk about what's going on. So first of all, to start off with a bit of a summary, and then we'll talk about different statistics right now that are not looking ideal, is that there is some sort of it seems short-term liquidity crunch in the United States. All right, so what does that mean in liquidity crunch? It basically means that cash-intensive businesses, such as banks, but not only banks, have difficulty getting cash on their hands. And they can get cash on their hands very often, although we've also seen an increase in mortgage-backed repo loans, right, and overnight loans. But ultimately, the rate they have to pay to get those short-term repo bills, etc., is higher. So there's a bit of a liquidity crunch, and that has several causes and several symptoms. And we'll talk about that, but that's generally what is going on, and generally what the main thing is that you need to know. But that word is being thrown around a lot, so let's talk a little bit about what that actually means. Now, first of all, the first thing that we need to talk about is obviously the balance sheet and the monetary policy by the Federal Reserve. So that's what you can see down here. This is basically whether the Federal Reserve is doing quantitative tightening. Which basically means that, you know, the Federal Reserve also buys up treasuries, and it buys up mortgage-backed securities. And quantitative tightening is that when one of these loans runs out, right? So if you have for example, a 30-year mortgage. I'm butchering the pronunciation on that. My apologies. But if you have that and it runs out, so after 30 years, usually they renew that with new mortgages. But with quantitative tightening, they don't do that, or they don't do that with all of them, what means that their balance sheet in terms of these equities that they hold decreases. That's quantitative tightening. That is what the Federal Reserve has been doing since June 2022. This is decreasing liquidity, but if done right, it doesn't decrease the liquidity that it means that problems will occur. But ultimately, this is one of the reasons why problems can occur. I mean, if there's quantitative easing, there's plenty of liquidity to go around. However, there's a couple of things that are going on, and these are more symptoms of something happening. But there seems to be, in general, different movements in the financial markets, and for banks especially, that cause liquidity to be quite hard to get their hands on. And you can see right here, for example, if you take a look at the repo operations. So this is basically when. It's very simply said, but still, when banks and when other businesses need cash, and they get cash from the Federal Reserve, and they put up these securities, right? So very often treasuries, but other times also mortgage-backed securities, and then they buy that back, right? So that's why it's called a repo operation. they buy that back very, very quickly afterwards. So this is when they need short-term cash. And you can see that has increased significantly in October. And this is strange, all right? I mean, if you look at, this is the last year, you can see the last year, this barely happened. And then if you go back in time, it happens very often when we had some sort of a liquidity crisis. So that is also not what you want to see. 2001, for example, but also 2007, it increased quite a bit. This is not amazing. I mean, it's obviously not as high as it has been in the past, and it's also different this time around. But there's something going on here, which means that liquidity is not passing around as much as we'd like to see that. And that is also something you'll be able to see if we take a look at this, right? So here you can see the SOFR, so the overnight interest rates basically versus the Federal Reserve base interest rates. It's again very simply said. This is the spread around that, and usually when the spread is increasing, that means that there is more risk, or that it's more difficult to get your hands on liquidity. So that is essentially what's going on. Now, what's causing that liquidity crisis? We can talk about that for hours, all right? It's partially quantitative tightening, but there's some other things going on as well, I'd say. But that's what's going on, and that's why the volatility index is elevated, right? So the financial markets are kind of spooked. It is decreasing though, by the way, and that's the good news. And that's also why equities pushed down quite a lot over the last week, but they are recovering. So what to expect? Well, first of all, this is something that is difficult to say. I do expect, if I look at the S&P 500, I don't expect a crash. Right, I don't expect us to get into a downtrend. I think we will be able to hold, especially this level at 7,640. So that's for the S&P 500. But short term, I would still be cautious. I mean, short term, we can still see that the repo operations are extremely high. Friday they were high, but yesterday they were high as well. That means that there's more risk. And short term, we still know that there's quite a large spread. Now the spread is decreasing, as you can see today, but ultimately it's still relatively high. So therefore, I would still be slightly risk averse and say, okay, be careful with any stock trades you're doing. And therefore, I would also say it's best to assume that we'll push down a little bit lower before finding support, at least for the S&P 500, and pushing up higher. I don't think that this will continue long enough and that this will escalate long enough for the S&P 500 to get into a downtrend. All right, so short term, what I would say is most likely, if we're talking about the 1 hour time frame right here, is possibly something like this, okay? And then consolidation, and then ultimately a continuation. I mean, I should not have to remind you that the earnings season we just had was still phenomenal, right? So I think the stock market is still inherently strong. And that is what I think you need to know. So hopefully it helps a little bit regarding understanding the stock markets. But for now, that's it. So thank you for watching. Take care and bye.